Good morning. It is Thursday, May the 7th. Here's what's on the agenda. Iran and the US weigh a potential deal again. Maersk and Shell report with the war impact in focus. And chip designer ARM disappoints as the broader AI rally powers on.
Let's check in on some key markets then, Tom, and where we are after what has been an incredible 24 hours in markets. The Brent oil price has certainly been on its own journey. We were at 107, 108 before we got those news lines on the one-pager Axios report of yesterday. That sent the oil price down to 97. We've bounced a little since then, but we're pretty calm this morning, up by 0.5% at 101.75. Eurostoxx 50 futures also going on a bit of a journey yesterday. We actually closed the day up by 2.7% on that particular index. Is there more to go? Is it all done? Is it all done for the dollar? The dollar, actually, the Bloomberg Dollar Index, back at levels that we saw at the start of the war, just before the start of the war, crucially. So is that it? Do we have more to go on the dollar front? The countdown to the opening trade starts right now.
They want to make a deal badly. And we'll see if we get there. If we get there, they can't have nuclear weapons. It's very simple. But what's not to submit? Their missiles are mostly decimated. They have some. They have probably 18, 19%, but not a lot by comparison to what they had. And their leaders are all dead. So I think we won.
There was a lot of winning yesterday, wasn't there, when it came to financial markets? Yet another Axios rally delivering a good outcome for some. You were short oil yesterday. You were long stocks yesterday. Obviously, timing that rally and sizing that story was very important yesterday. So what are we now priced for this morning? A return to normal, more winning, total victory? It's interesting, isn't it, in terms of where we now find ourselves? Basically, what you've got here is a situation where many believe that we're not going back to 450 on gas in the United States. We're not going to 440 on the US 10-year. But what are we really priced for this morning, and where does it leave us?
You talk about 440 on the 10-year, 450 on a gallon of oil, and that brings me to the timelines question. Again, as the evidence mounts that President Trump and his team want to get a deal, he says the Iranians are desperate for a deal. There's a lot of evidence that Trump wants to get a deal. It takes us to the meeting that is going to happen with Xi Jinping in Beijing next week. Does he want to get this MOU signed before then? That could be helpful. And then, of course, the midterms. That 450 per gallon of oil takes us to the midterms. And we know the polls show he's under pressure. This is not a war that is fully supported in the US, and he's suffering in the polls. So those timelines could be factored in for investors as well.
Absolutely. To do with China and to do with the domestic politics, just taking stock of where we have got to, we have seen the Iranians presented with a US plan that is, yes, this memorandum of understanding, but we haven't yet heard from the Iranians on that front. So we don't really know if we've got closure on that particular angle. Will this result in the opening of the Strait? We still don't have clarity on that, but the market has been predicting that that's where we are heading for, and that's why we've got lower oil prices. It's interesting, have we travelled too far too quickly on a host of assets? I noticed Brendan Fagan on the Markets Live blog pointing out that the S&P dropped 16 index points in connection with the war in the immediate sort of period where we were worried about the war. Since that bottom, it's jumped by more than 1,000 index points. Yep. There are other things at play, AI, of course, in the results story.
Two different things. Are they interacting? Do they interact at any point? We'll come on and talk about tech in just a moment. But where is the market price this morning? Is 100 a reasonable price going forward in terms of the price of crude on Brent? Are interest rates about right? What are we pricing? At what level are we trying to kind of position ourselves for now? And that's the bit that I wonder, have we come too far too fast? Have we priced in a return to normal? Is that what we're looking at here? And I just kind of, what signals do you take from which assets as to what happens next? Because equity markets have rallied. Yeah. Tech stocks have driven us sharply to the upside. Brent has come down a bit. Bond yields are remaining relatively sticky. What are we pricing here? What kind of outcome are we pricing
And
here?
On that subject, we have a cross-asset guest at 8 o'clock who has a lot of thoughts on the way that different assets are telling us different things right now. And so that'll be an interesting conversation to dive into. With that in mind, let's think about where we are on stocks and bring some of these themes together, actually, because we've had results out from Maersk, which is interesting on the stocks narrative, but also on the geopolitics, because this, of course, is a shipping company that's been very much caught up in what's been going on in the Middle East. So what is interesting here is they seem to be trying to tell a story, or telling a story of steady as she goes, still seeing full-year underlying EBITDA 4.5 billion to 7 billion. That's the range they previously gave. And a number of these headlines start with Maersk still sees. So they're not trying to change the market's expectations versus where we were a quarter ago, which I think is perhaps interesting, because this is a business that will be benefiting from higher freight rates, but of course not benefiting from disruption in the Gulf and also the higher energy costs that they, as many others, will have to face.
That's quite the range, isn't it, in terms of the full-year underlying earnings, from 4.5 to 7 billion at the top end. But to your point, is this conflict a net positive for Maersk in terms of shipping rates versus that cost of fuel, of course? And we're going to be speaking to Maersk later in the programme. Shell coming through with some very strong numbers, Anna.
Yes, so the adjusted profit 6.9 billion against an estimate of about 6 billion, announcing a share buyback programme of $3 billion. They're saying that their profits surged in the first quarter as the Iran war drove oil and gas prices higher. Of course, we could have expected that, and it caused considerable volatility that boosted its big trading business. So we knew that the trading business was going to be strong, and here we have a little bit of visibility perhaps on some of that strength.
We want to talk about what's happening in the tech space as well. I mean, AMD was remarkable yesterday. We know the earnings were strong, and they saw, an 18% rally in that stock price. I think that's the record jump that you saw for AMD yesterday. So that ties back to your point, Guy, about what we're seeing in terms of these two separate narratives, or at least the AI story continues to drive the gains, and if and when there's going to be a catch-up in terms of the material impacts of what's happening in terms of inflation and the lack of energy. We also got earnings from ARM, the designer, of course, of these frame sets for chips. What was interesting, I think, in the ARM story was they continue to push to the optimism and guide towards the upside that's going to come through from the data center part of the business. They potentially see up to $2 billion of additional revenue through 27-28 as a result of their so-called AGI CPUs. That is a big pivot for this company. But they're seeing some softness in the smartphone business, and that stood out from the numbers, and that seemed to drag. It was quite a choppy session for ARM, but ultimately it ended low. Yeah. Still, they get a majority of their revenue still from the smartphone business. They kind of want to make that yesterday's story and get fully loaded on data centers. They're still on that journey.
Is there in terms of the AMD story, what is the lesson that we take away from AMD? What is this story that you get from that? Here is a company that is embedded into the data center story, the CPU, not GPUs, but what happens next in terms of what that narrative for them? Well,
GPUs are part of the story for AMD, absolutely, but CPUs as well, across three different key areas for AMD. So it's the GPUs, the CPUs, and then it's the microprocessors that go into the data centers as well. So on all three metrics, they perform positively. I think the key story to take away probably is this is becoming a bigger challenger for NVIDIA. It is starting to take market share, and there had been a major question as to whether or not AMD could take significant market share from NVIDIA. NVIDIA remains the leader in terms of market share ownership in GPUs, but AMD is playing a role there.
Vincent Clerc, we just said, is going to be joining us very, very shortly. He is the Maersk CEO. Henrik Andersen, Vestas' CEO, is going to be joining us too. We're going to talk wind power there. Berta de Pablos-de-Barbier, Pandora's new CEO, will be joining us later on the show, as will be Fabio Bassi, JP Morgan Securities cross-asset strategy head.
Here's what else we are watching throughout the day. 9 a.m. UK time, Norges Bank rate decision. And later today, UK local elections, Scottish parliamentary elections, and the Wales Senate elections as well. 1:30 p.m. UK time, it's US initial jobless claims. And on the earnings front, out of the US, McDonald's, that's before the market. A touch on the US consumer. And later, Marco Rubio will be meeting the Pope.
OK, what else do you need to know this Thursday morning? Let's run you through some of the details. 2 passengers of a cruise ship at the centre of a deadly Hantavirus outbreak have arrived in the Netherlands for treatment. The pair were evacuated from the vessel, which has begun sailing towards Spain's Canary Islands. The Spanish health minister says the ship will likely arrive in Tenerife on Saturday, with foreign nationals set to be repatriated. She confirmed all passengers and crew remaining on the vessel are asymptomatic. The US government has begun to pay refunds for tariffs ruled illegal by the Supreme Court earlier this year. Multiple trade lawyers representing US importers have told Bloomberg that payments have been received and that at least one included interest. Officials are due to update a New York trade court on the refund process next week. And GameStop's CEO says his eBay account has been suspended after a publicity stunt in which he listed a raft of personal items to fund his $56 billion bid for the online marketplace. Ryan Cohen's accounts racked up scores of bids, totaling tens of thousands of dollars for an array of items, which included socks, and vintage baseball cards. The fund rating is unlikely, though, to sway skeptics who view the GameStop bid for the company 4 times its size as something of a non-starter.
Yes, he's faced a lot of questions about that, hasn't he? Coming up on the programme, we'll stick with these earnings themes this morning. Vestas gets a boost from strong demand for its wind turbines. We'll speak to the CEO of the Danish firm as it navigates ongoing geopolitical and tariff risks. Plus, with Shell reporting this morning, we will take a look at how oil majors have fared in the earnings season, dominated by conflict, of course, in the Middle East and higher oil prices. Up next, we'll be joined by Vincent Clerc. He's the CEO, of course, of the shipping giant Maersk, just reporting numbers. We welcome your thoughts if you want to get involved in any of these conversations. IB plus BBTV Go, that is the function on the Bloomberg terminal. 7:10 here in London. This is Bloomberg.
46 minutes to the start of equity trading here in Europe after yesterday. What are we looking at? We're looking at a fairly flat picture. Nasdaq futures are a little negative right now. European futures are fairly mixed. You've got an awful lot of corporate earnings, though, to fold into the narrative this morning. So let's talk a little bit about what we are seeing right now. One of the big corporates reporting is the shipping giant Maersk. Let me just run you through some numbers. The EBIT line, the operating line, looks a little ahead of expectations. The EBITDA line looks a little ahead of expectations. Revenue, a little ahead of expectations. These are all Q1 numbers. The company says the Middle East war has had a limited impact on its Q1 results. Vincent Clerc is the CEO of Maersk, and he joins us now. Vincent, always a pleasure. A limited impact. What does limited mean?
Well, I think limited means that because of how we do revenue and cost recognition, the war that started in February really is gonna have an impact in the second and third quarter, where we're going to see the energy prices going up, and we're going to see also the measures that we have taken in order to mitigate those increases. The first quarter by itself, I think, is a strong quarter, as you mentioned, strong on revenue, strong on cost, which generates a beat on financials. So we're very happy with that, despite the fact that there is an overhang of capacity in the shipping division that does press the pricing environment. But really, I think the efforts over the last 2 months have been on commercial measures to pass the extra cost that we have. It's about $500 million a month of extra costs we're taking since the beginning of the war that we need to pass on to customers. And so far, we're able to maintain our guidance because our experience is that we're able to pass those costs on to our customers.
Okay. So as you indicate, maybe the second and third quarters, though, look a little bit tougher, though you believe that you can pass some of this cost on, most of this cost on. So if you would describe the effects of the war as in the first quarter as being limited, can you come up with a word that would describe what you think the effects will be in the second quarter?
I think in the second quarter, we're going to see a significant increase in our cost base. I mentioned about $500 million in cost per month that we will see increasing between March and April and May. So for the quarter, it's $1.5 billion in extra cost that we need to recover from our customers in full if we want to protect our financial outlook. And that's what we've been working on since the start of this war. Full recovery of these cost increases from customers, and so far we're positive that we can maintain this in the quarters to come. But there is, of course, a lot of uncertainty if we look further into the year with respect to what are going to be the secondary impact of this war. Inflation, possibly reduction in demand. Demand has been one of the strong features in our markets for the past couple of years, and certainly also in the first quarter. We see that continue in the second quarter. But there is, of course, some question marks about how this is eventually going to flow through the economy and what impact it's going to have on the market. So we remain cautious, but so far positive on what we've been able to achieve so far with respect to mitigating that and get to a bottom line impact that is not material.
Okay, so Vincent, good morning. So success so far at passing things on to customers, as you've said, but customers could change behaviour, I suppose, and if we saw demand destruction as a result of higher prices, they might do so. Are you preparing for that kind of eventuality in the second quarter?
Yes, absolutely. I think there's a couple of levers that we have that we're looking into right away. Of course, the core cost increase is on fuel. This also allows us to actually relook at our schedules and see if we can set down the speed and therefore reduce the amount of cost that we're taking, reduce our fuel consumptions, and thus reduce our amount of cost. We can actually reduce the overall impact that this is going to have. So, first measure, cost recovery. This has been successful. Second measure now is to prepare for all eventuality. And if we see a softening in demand, we're going to need to act on costs so that we maintain things in balance and protect our margin. And I have really great confidence that the team is going to be able to continue to live up to the challenge here. This is at a different scale from what we have seen before, but the mechanics of it are pretty similar to what we've seen in previous oil shocks.
Can I ask you about the freight rate story as well, Vincent? Because that there was quite an evolution in freight rates in the first quarter, which is the sort of backward-looking story. But looking ahead, what are you expecting to see on freight rates? Are you expecting the jump associated with the war to be sustainable?
Yeah, so the first quarter here is 14% down compared to a year ago, and it reflects the record deliveries of new ships that there has been in the past 12 to 15 months. And this has been putting pressure gradually on the shipping markets. The war has been a bit of a turning point because of the cost increase that I mentioned. So what we will see in the second quarter is actually freight rates going up in line with what the costs are being doing. And you can see already, if you look at some of the freight indexes out of Asia, that they have jumped about 40%. Which is very much in line actually with what we needed to see in order to do a full cost recovery on the container traffic.
Vincent, how quickly do you think those freight rates snap back if we do get a reopening of the Strait of Hormuz?
The way we look at it is that the freight rates are not correlated to whether Hormuz is closed or open. There's between 2 and 3% of global trades that go through the Strait of Hormuz. This has been heavily disrupted, but this is not really what is impacting things. What is impacting freight rates is the energy shock that we're going to be, and our belief is that those energy costs are so high that nobody can just shoulder them. And therefore, the prices are more likely to tack closely to what oil prices does, which is probably going to be with us for a longer period than what we have seen, what we will see on Hormuz or in the situation itself, because the more this situation drags on, the more the deficit in oil production increases, and the longer it's going to take for things to normalize from an oil price perspective. And I think that's really what we're looking at right now. How long can that take, and what is the possible demand destruction that will happen as a result of prolonged high energy costs?
And that takes me back to your point and your answer around the $500 million monthly additional cost as a result of those higher energy prices and the fact you've been able to pass that on to your customers. When do you face pushback? Is it when you get to 700 million, 800 million, $1 billion a month? When do you expect customers to push back and say we can't take this additional cost?
Well, I think I think we will feel pushback if this is starting to bite on the demand that there is for the end product. I think we need to realize that an increase of $400 or $500 or $600 on a container is a relatively very small increase on a per unit basis for the sale price of the end product. So from that perspective, as long as there is demand for the product in the consumer market, and you have a broad increase in cost base, those costs should be able to be passed on and should be able to be either absorbed or passed on to the end consumer. I think if our customers start to feel that they start to cannibalize the demand that there is for the end product in the consumer market, you will start to feel more pushback and possibly some demand destruction, which then we will need to mitigate through costs and manage our capacity very closely in order to make sure we don't end up in a spiral where this becomes a negative cycle. So far, we've been extremely successful with it. I think it's a tribute to the team here, but also to the discipline that there has been across the industry in the face of this unprecedented shock.
Vincent, can I just get a little bit of inside information as to what is actually happening in the Gulf right now? The Alliance Fairfax, which I think is one of your vessels, navigated the Strait under being shepherded by US ships. I understand, earlier this week. What did the captain tell us? What did the captain tell you? What did the captain report as to what that experience was like? What did you learn from it? What is your communication like with the US Navy? Just give us some colour as to what the situation looks like in the Gulf and how that vessel fared.
Yeah, I think the first thing that I want to say is we have multiple ships that are stuck in the Gulf, and we've taken a very prudent approach towards what we can do to get those ships out, because the safety of the crew is our really utmost concern. The Alliance's Fairfax is actually the first ship since the beginning of the conflict that we've taken through the Strait of Hormuz. We got approached by the US Navy with a view that they wanted to move some of the US flagships out under heavy protection. This dialogue has been ongoing for days as the details of the mission became clear, and how the US military intended to protect the crossing for those ships, how this was going to unfold. Once we had the full plan, we took the assessment about whether this was safe enough that we had to ask the crew to get through the Strait of Hormuz. And I think that the means that the US military has deployed to ensure a safe crossing of the Strait of Hormuz for the Alliance Fairfax, they were extremely conscientious, with a really, really high regard for operational safety. And on that basis, we agreed to let the ship go through the strait. And this has gone, I would say, without a hiccup. And everybody was safe and sound on the other side, and I think quite relieved to have both the ship and the crew on the other side and now ready to get back to work.
Vincent, you say you've got multiple ships still stuck then in the Gulf, wishing perhaps that they could make a similar passage. How long can they stay there? What is the limiting factor?
Well, I mean, there is no real limiting factor. They will stay there as long as the situation is unsafe. A large part of the strait is mined today, so it's impossible to cross it. There are two roads, one very close to the coast of Iran and one very close to the coast of Oman, which have been confirmed have no mines. But as long as there is a naval blockade, since you have only these two routes, it's fairly easy to monitor what is going through. As long as there is this, they will have to stay there, because we cannot risk the life of our crew, we cannot risk our assets or our customers' cargo also by going through something that is unsafe.
Okay, Maersk CEO Vincent Clerc, thank you very much indeed for your time. We appreciate it, of course, on the back of the earnings, but give me some colour and some detail around what exactly happened with that Maersk ship, that US flag ship that was aided by the US military to get through the Straits of Hormuz, and what led up to that, and what gave him, Vincent, and the team the confidence to be able to green light that operation.
But quite a detailed process.
Yeah.
A lot of planning clearly went into moving this vessel. To your point, lots of other ships are there. Can you repeat that time after time after time? The flow is going to be incredibly limited.
Well, if it was some sort of proof of concept, then maybe there's proof. But yes, what are the other factors you need to consider? The amount of military commitment that is required to do that. If we're back to thinking about it, interesting on the results side that he cast the second quarter as a quarter where you'd see significant impact on costs, whereas the first quarter was limited. So I thought that was interesting, helping us extend our horizon.
Clearly worried about inflation, clearly worried about the growth impact longer term as well. Through the rest of this year. Coming up, a first quarter beat, meanwhile, for Vestas, as that firm sees increased demand for wind turbines. We're going to speak to the CEO of that company up next. This is Bloomberg.
Thursday the 7th, good morning. 30 minutes to the start of cash equity trading here in Europe. Futures are currently pointing us to a fairly flat start, but after yesterday, I think that probably is understandable, given this significant rally we saw for European equities and US equities. Currently in the States, the S&P is fairly flat, the NASDAQ just down a touch. right now, but a little pause maybe.
Yeah, a little pause in bond markets as well then, Guy, as well. Yesterday we got the US confidence about what's going to happen in the Strait of Hormuz, of course. We await the Iranian response. But the US confidence was enough to send yields considerably lower because, of course, they reflected a much weaker oil price. It went down to $97 a barrel. Tom, it's now back at 101 on Brent.
OK, and we can link that oil market disruption and the price volatility to what's happening in terms of the wind space as well, because Danish wind turbine maker Vestas saw profits beating estimates in the first quarter as its order backlog reached a new high of more than 36 billion euros. Joining us now, very pleased to say, is the Vestas CEO, Henrik Andersen, on set with us. Good morning. Thank you. On the back of these results, the demand is strong. You beat top line on the earnings. The backlog is looking pretty significant. Does that demand continue? Can you build on that in the current quarter and the quarters ahead for the business? What is the strength looking like, and what are the key drivers at this point?
Yeah, no, and I think it's a sad background because, of course, now we have the word energy crisis once again in the quarter as a heading. I think there's no doubt that most, at least European politicians, are looking exactly at the same percentages split as they had 5 years ago or 4 years ago when we had the last energy crisis. And I think everyone here, and especially in Europe, we sit in the UK this morning, and Germany, UK, Germany are doing it. They are accelerating permitting. They're accelerating the capacity build out because right now Europe need and requires more self-grown, homegrown and independent energy supply. So that, of course, bodes well for us in Europe. It also bodes well for what we have seen on the onshore in the US, and of course on the offshore. We have now turned that corner where we can see our manufacturing ramp up is really well positioned.
Well, to your point, Ukraine was meant to be the wake-up moment for Europe. Is this the wake-up moment? Are you seeing a material and significant shift in terms of how European leaders are adjusting to this? Is there a structural change that will benefit your business going forward?
As we all know, we have elections every fourth year, so I think somebody probably feels that they're inherited when you're coming new into the office these days and blaming a little bit, why didn't we do it 4 or 5 years ago? We are building 30 years energy supply assets, and I think sometimes that's 30 years against a 4-year election cycle sometimes brings some of the challenges in a bit of non-decisive. And if we look at EU 27, Germany is literally now putting as much up as the rest of EU 26 is doing right now, and that's probably a telling story. So full praise to the German government and Katharina Reis, who clearly leads that action right now.
OK, so that's the step change perhaps that we're seeing. Is that what it's going to look like then, Henrik? Is it going to be a step change in demand for your products, or is this more gradual?
I think the real positive for us, of course, is that on the levelized cost of energy, it is very supportive. You've seen that in the UK when you open auctions, when you see it in Germany, you open auctions, they are coming in at probably 60-70% of what is in the grid, clean grids pricing. So therefore, the solution is fast, it's affordable, and it will give also the European society, it will give us a lower energy price if we build more of it. So, I mean, what's not to like? So I will sort of say here, I have no doubt about that. But of course, end of the day, somebody has to do that decision making, government, municipality, to get the permitting through. And if we are still looking at a 6-7 years red tape process, hey, then we sit here again in 5 or 6 years and saying, well, we moved a few percentages.
OK. And do you think consolidation within the wind industry in Europe is something that's going to be talked about more? There's a lot of Chinese competition. Some parts of Europe have stopped the Chinese operating in their markets, but others haven't. Do you think consolidation within the wind space is something we look to?
That will at least require that Brussels then change some legislation, because today the competition laws in the EU has very much focused on the EU competition or European competition, rather than necessarily allowing critical space or industries to consolidate. So if we want to have a global champion also within wind, of course, that has to come with a requirement of different legislation. Otherwise, I'm not embarking on it, because it will be a no thank you from Brussels in most of our industries.
Should Brussels ban Chinese competitors?
I don't know in the sense of, I think we probably are getting much better in saying what's important for us. I think in the category of critical infrastructure, you got defense, you got energy. And I think here, when China 4 or 5 years ago, to some extent says no thank you to turbines from outside China on their grid, I think it's interesting that we have been sold the same version or story back now 5 years later. So if I can sort of say it a little bit with a smile on my face, maybe we should follow the good decision and advice we got from China 5 years ago.
So I'm going to decode that. That was a yes.
Yes, in the sense of if we really think here, we're sitting with a grid and we're sitting with a energy supply, being in the hands of somebody else having the code to that, I don't think is right.
Okay.
And therefore, number two is when we look at this, whether you are importing energy or you are putting it in other hands, same result, same consequence. So we got to stand up to it. We got the capacity, we got the homegrown industry here. So why not take advantage of it?
Vincent Clerk was just talking about inflation.
Yeah.
What's inflation like for you?
Clearly, inflation will be coming some quarters down the line. We spoke about it yesterday. We don't see much right now. I think for us, a lot of it has been about mitigating. It's only a few quarters ago we sat here and discussed Suez, and now we are Hormuz the thing. And I think for us, not really a big challenge when it's sort of a momentarily increase in either energy prices or whatever. Otherwise, of course, it will come through the components and supply chain at some point in time. But outside that, I think, at least positively, been able to mitigate the physical delivery. So it's very similar to Suez. We're able to run it. We're able to do what we normally do. And then at some point in time, good people like Vincent will come and say, well, actually, my underlying cost has gone up. But on the other hand, as Vincent also rightly saying, seems like I got quite a lot of capacity. So I'm sure Vincent will find a good balance of that. I think we've not having the greatest success when we've been on the same line on a Q release here and start discussing.
We're going to get you both here together.
We should make sure we do that. The US, how challenging is that market right now? Trump famously hates turbines, windmills, as he describes them. And he's taken measures to stop particularly offshore development in the US. What is that market looking like right now? Are you having any constructive conversations with the Trump administration?
I think here sometimes you just have to say that you can be so much emotionally on a certain thing that you should let go of it. And I as I said, I think he has had a run on the wind for not only a couple of months, but probably
decades.
for forever.
Yeah.
But the truth of it is also in the US, which is probably the home of allocating of capital to what makes sense. And if you look at that, there's nothing in there that prevents you from putting quick electron solutions up, because they need electrons. They need molecules, they need electrons, because otherwise the electricity price will keep rising. It's probably up in most states in the US 2.5 times. So of course there, time to electrons, time to electricity is of really a really sensible, everyone is looking into it. So if you have a project and a permitted project there, you will put it up as quickly as you can. And of course, that's what we do. We have and this is also the other thing, which is sort of, wind comes from only one part of the world. We have factories in the US, they're working. We have more than 5,000 colleagues there. So it is US built for US customers and US consumers. And it comes out right now, as a build price of probably less than 40% of the grid price. So what's not to like? And that's what capital allocation, I think, is doing in the US. So order intake in the previous quarter has been good. We know that even also after a tax-exempt clearance, with the current electricity prices, no problem.
Yeah. So that's the story in the States. Here in Europe, I don't know how much you follow the central banking story in and out, but there are going to be lots of central bankers thinking about whether to put up interest rates. Give us a sense of how sensitive your industry is to a higher interest rate.
Oh, but you have seen that. Yeah, I mean, you have seen that in terms of both the offshore developers being suddenly caught in a rapid changing from a zero interest rate environment to a much higher interest rate environment. So I will say there is something there, but I also think we learned a lesson. So when you talk about it now, I think central banks will also be worried, because, of course, they can also see that consumer confidence is going down. Mm-hmm. So therefore, are we increasing interest rates only to cope with the energy inflation or to battle the energy inflation. And that's probably not a great weapon to use.
Thank you for joining us for Denmark Day. It's been a great pleasure having you here.
Fantastic. It's nice to see you.
Yeah, nice to see you too. The Vestas CEO, Henrik Andersen. OK, we're going to turn to that rate story next. Some Fed policymakers are warning about inflation risks linked to this Iran war.
We have risks both on the employment side and on the inflation side. In my understanding, the risks have been shifting towards more risk on the inflation side than the employment side. In terms of monetary policy, which I guess is what you want to hear, my own views are that there are very plausible scenarios under which the economy would require us to keep the policy rate at its current level for some time.
St. Louis Fed President Alberto Musalem speaking there. We're going to get the latest on the state of talks between the US and Iran. We will do that next. This is Bloomberg.
Welcome back. We are about 15 minutes away from the opening trade. European futures are pointing up by 0.3% after a very solid day. We gained more than 2% yesterday. It seems that the risk-on momentum is starting to edge a little higher as we look at these futures, pointing to gains of 0.3% potentially.
Oil's just kind of down a little bit. Brent's still north of 100. We've obviously seen a big move over the last session. This time yesterday, as you can see, we were significantly higher. This as we watch to see what happens with these fresh proposals about ending the war in the Middle East. Bloomberg understands that Iran is expected to send a response via Pakistan kind of in the next few hours, days or hours. It is unclear at this point. So what do we know? What do we not know? What do we need to know? Bloomberg's Jumana Basecci joins us from Dubai. How close are we, Jumana, to a deal?
Well, Guy, I think you need to draw a distinction between the U.S. presenting a one-page memo to end the war to an actual full resolution to the war. And per our own Bloomberg reporting, the Iranian side still have not officially responded to that 14-point plan that was reported yesterday. Now, what we understand to be in it, though, is a working towards the full end of the war. It would include an immediate end to hostilities and then a 30-day period in which negotiations would begin surrounding the lifting of the mutual blockades around the Strait, reopening of that nuclear file, discussions around the time frame of uranium enrichment, and then also handing over the fate of that highly enriched uranium stockpile. Of course, we know that they're sitting on more than 400 kilos worth of 60% plus highly enriched uranium. So that is a big topic that was even a topic before the war kicked off. And then the final point is Iran and what they are going to be asking for, which is a considerable amount of sanctions relief in exchange to agreeing to all of those terms. So you started off by asking me how close we are to an agreement. We don't actually know, but what we do know for sure is that the situation today is very different from how it was a couple of days ago when we said President Trump was facing a key decision, whether to go down the route of once again amplifying hostilities, going back to kinetic warfare, or making another diplomatic push. What has become apparent in the last 2 days is that they are going down the diplomatic route. It may be coincidental because he's got this Trump-Xi summit to look forward to next week. The Iranian foreign minister was in China as well yesterday. China really pushing for a diplomatic solution and, of course, a reopening of the Strait. But I guess the question is, at what cost is it going to be? Because Iran are maintaining that they want to maintain this new protocol. They've established this new authority for vessels who want to pass through. They will be putting forward a long list of demands to the U.S. in order to give up that point of leverage should these negotiations continue. And so it's difficult to see at this point whether the gap between the two sides can actually bridge and whether you can bridge that gap in a simple one-page document. But markets seem to be rallying on it. I would just say take it with a pinch of salt because we have been here before and President Trump has said many times throughout the course of this war that Iran are willing to do a deal. But again, what the details matter here.
Jemana, thank you. Bloomberg's Jemana Basetchi, of course. And to that point, oil prices dropping again, down 0.5%. $100 is where we trade on Brent. Let's turn now to today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore, who joins us now. We were just hearing from Jemana about the timing of the Xi-Trump meeting next week, Mark. And I wonder if that is starting to loom large on or in the thinking of market participants right now as they watch the strength that we've seen in equities on the back of limited news flow, really, out of the Middle East.
Very much so. I think it is the big event risk. And I say that despite knowing that we've got non-farm payrolls tomorrow, which is normally a big data point. But in reality, we're not going to worry about that job story right now. The big factor is, of course, the AI theme and the tail risk of what might happen in the Iran conflict. So I think Xi-Trump is bigger than the data that's coming out. And then you've also got the conflict itself. Now, the base case from markets is that there's incentives from both sides, both Iran and the US, to keep some kind of ceasefire negotiations going into that Trump-Xi summit. It'll be very hard to have that Trump-Xi summit happening amid a major re-escalation in tensions. So that's why people are assuming it'll be positive into the summit. The one other reason why it looms very large in the radar, not only because obviously there's such key players in global markets, but also because, something we've experienced over the last 18 months or maybe a little bit less is the concept maybe of a Trump call. We used to talk about the Fed put, but quite often when markets are trading most strongly is when we get a curveball. And I think there's a little bit of understanding from markets that if we go into that meeting with kind of confidence around Iran, stock markets at record highs, everything looking good for Trump on the markets and economy point of view, then that when he might be most aggressive on China demands, and that's when it might really collapse and we suddenly might get some dramatic headlines about trade warfare, etc. happening. So I think the base case is to be pretty positive into that meeting or its cancellation, but it's an extremely hard environment for traders, because even though the base case is for continuing to see this rally, this extraordinary rally, the risk reward it gets increasingly uneasy as we get closer to the summit.
Mark, how comfortable are you with the nature of this rally? We saw it broadening out a bit yesterday. About 60% of S&P stocks were in positive territory, about 80% in the Euro Stoxx 600. So a little bit of breadth yesterday, but the nature has been quite narrow in recent days and weeks. Is that a concern? Do you worry about the kind of, again, this narrative of a lack of breadth with that domination of AI?
The short answer is no. Breadth doesn't worry me too much. This is an AI-driven rally, but AI are all the most important names. It's the most important theme in markets, and it looks like it's got legs to go further. I think we're still in that inflation stage of that bubble. So I think AI will continue to drag the market higher, and actually other parts might play catch up in the short term.
How far does it take us?
So I think it'll actually be, again, even from here, more powerful than people expect. It's one of those rallies where everyone's going, it's too far, too fast. I get it, but you need a catalyst to change. So even though it seemed extraordinary from here, it's going to get more rocky, it's going to get more volatile. Because we're seeing such a powerful move, it means that the negative headlines, people leap on them, they get very excited. But ultimately, with the core momentum higher, I think we're going to get some really crazy, superlatives over the next week into that meeting, when then we'll see.
OK, brace for those crazy superlatives. Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis, of course, and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get your stocks to watch this Thursday and bring in Chloe Melly. Chloe.
Good morning, Tom. Maersk is going to be in focus this morning after saying that the global shipping market had remained quite solid, quite resilient despite the Iran war. And so it maintained its guidance. And it seems that benefits and drawbacks are kind of cancelling each other out for the company. So it is benefiting from those higher container rates, but that is being offset at least partially by those higher fuel costs and higher insurance costs. And so we'll see how the stock reacts to that this morning. We've seen obviously a huge jump in those shares when the war started, and that's been pared back since. So we'll be definitely keeping an eye on Maersk this morning. Moving on to UBS, which is also in focus after the CEO said that he cannot rule out an acquisition when it comes to thinking about growth and expansion plans in the US, saying that he doesn't know about any big organizations that can rule out those kinds of acquisitions. And so we'll be keeping an eye on that stock. It has seen actually a lot of ups and downs over the last few months, primarily because of some of the back and forth around capital requirements. But news of potentially some big M&A that might actually lift the stock this morning. And finally, Siemens Healthineers is also in focus today after cutting its outlook. So it has seen a few challenges, one of them being inflation and the other one being a new pricing policy in China that's aimed at lowering healthcare costs, and that is creating a bit of weakness for the company. It has been underperforming its closest peer within that medical equipment space, which is Philips, for quite a bit, for quite a long time now. And so that underperformance could continue on the back of that guidance cut this morning.
Chloe, thank you. Chloe Melly with some of the stocks in focus. There have been quite a lot of them, haven't there? It's Thursday, so we have lots of corporate reports. I bring the gloomy news. Campari, that's one of the stories that we're following this morning, and that is a stock that could be weaker at the open. Sort of weakness in the consumer seems to be part of the narrative there. Yep. Organic revenue growth, 2.9%. The estimate was 5%, so that's one that we'll watch at the start of trade.
Thought, possibly at a time of higher prices, you might want to reach for your Aperol spritz to soften the pain. But clearly that's not happening. No. So Anna's saying she's bringing the bat. I thought you were going to bring something light and drinks related with Campari. But the consumer. And both of our CEOs this morning have said that they are concerned about higher inflation going through later on and that impact potentially on consumer and their companies.
But it hasn't hit yet. So this earnings season's been spectacular. This earnings season has delivered everything everybody wanted and more. But they're all saying, just wait. Like, how's the second quarter going? How's the third quarter looking? All of that sort of stuff needs to be maybe factored in. Yeah,
that was very much the message that I was left with thinking about the Maersk results this morning. Q1, OK, not too much impact, but Q2, it's going to get more significant to our cost base. And we hope that customers will still take these price rises. But it'll all depend on to your point, on the end demand for the products that they are shipping around the world. So that's something that obviously we watch.
European futures are currently pointing higher by 0.2%. Gains of 2.2% yesterday. A storming session, of course, for European stocks and fresh record highs for the US as well. Coming up, it is the opening trade. This is Bloomberg.
Morning, how you doing? Thursday morning, couple of minutes to go till the start of equity trading, cash equity trading here in Europe. I'm not sure this chart actually tells you the story of what yesterday's session actually looked like, because what you don't see, you can just about see if you really zoom in, is the move higher that we got right at the beginning of the session on the back of the Axios story, which delivered the rally that we got. Equity markets were up very strongly, but we started down there and finished all the way up there. So this morning, maybe we are pausing a little bit, Tom, to figure out what happens next.
It does feel like the markets are holding their breath to see if there's more detail, more of a response from Iran, from the US to this apparent memo or MOU that the two sides potentially could sign. Any rhetoric, of course, any response from Trump, of course, also important. European futures then had looking to gains of 0.2% after a very strong day, to your point yesterday, gains of more than 2%. The US at fresh record highs. FTSE 100 looking to add 18 points. DAX futures pointing low by 22 points. And of course, the earnings story is front and centre as well, Anna.
Yeah, absolutely. Those earnings stories are front and centre. Let's start with the oil sector, though. Yesterday, we saw energy stocks were the only sector in negative territory. The oil price is not very different now to what it was at the end of the trading day yesterday. So not sure they have much movement in them on the back of the geopolitics. But we did have numbers out from Shell, and those numbers will factor those in. Of course, announcing a share buyback, and of course, the Iran war boosting oil prices and trading. So that's the story there. AP Müller-Maersk, we spoke to the CEO. The short-term story, the backward-looking story, pretty positive. What does that mean for the second quarter, though? Many more questions there. And Bouygues, the construction and other things business, first quarter adjusted current operating income missing estimates. So we'll watch to see if there's any downside in the French market on that particular stock, Guy.
OK, here we go. Thursday session. Kind of the morning after the night before is maybe how you would think about what we are seeing today. We're expecting a fairly flat story. Yesterday was obviously a day driven by superlatives. The Axios rally, once again, just allowing the market to kind of feel unleashed and ready to go, risk on. That was the narrative. This morning, it's a little more cautious. Stock 600, barely budging. FTSE 100, barely budging. You're going to see that story replicated across Europe. Below the surface, though, I think there's probably a bit more action to focus on. Sectors and single stocks, I think, will be where the narrative really lies today. So on that note, Tom.
We're looking broadly at most sectors in positive territory, but with that caution that you've been noting. Personal care near the top of the list. Interestingly, oil prices have adjusted and are slightly lower in the session today, so that's worth factoring in, of course. And you're seeing a bit of a bid for bonds as well. So travel and leisure was the top performing sector yesterday. It's back near the top right now, gains of 1.3%. Tech is also gaining 0.8%. The handoff from Asia strong again on that front. Autos also getting 0.6. On the downside, biggest losses coming through for food and beverage, down 1%. Energy also a little weaker on that sector by 0.7%, Anna.
I think we've got an ex-div on Anheuser-Busch, AB InBev, haven't we?
Yeah.
So we'll keep that in mind. But we also have a halt on Campari. And so if there is some negativity around what they're saying about the consumer, then that might factor into the food, beverage and tobacco sector. But yeah, we're kind of evenly split, aren't we, as you say. Travel and leisure does have another day in the tank, it seems. Not moving to the extent it was yesterday, but we do see the travel and leisure sector as being the best performing. Some of the hotel chains actually dominating the upside this morning.
It's interesting. I think Bank of America got a note out on ASML this morning, quite a significant upgrade in terms of where they see that stock going from here. I think it's 70. I don't remember the notes off the top of my head. Don't hold me to this. I think it's sort of circa 1,700. We're at 1,300 this morning. So that stock is up quite nicely. But Infineon is also tracking higher too. So the chip stocks are doing well. In fact, tech generally is up this morning. SAP, Schneider trading strongly. Legrand is also up in the power sector too. So you're definitely seeing that story, that narrative around the AI story, still very well represented to the upper end of this market this morning. Shell, though, down by 1.4% on the back of what it has delivered this morning.
Yeah, absolutely. So we keep that in focus. Let's get a perspective now across various asset classes. Fabio Bassi joins us, Head of Cross-Asset Strategy at JP Morgan. Fabio, nice to have you with us. Thank you for being here this Thursday morning. So I want to tap into your cross-asset thinking right now, because we do spend time sometimes in the morning trying to understand whether we're getting different messages from different asset classes. Yesterday was kind of pretty obvious, really. Oil prices dropped, stocks went higher, yields fell, all of it seem to be pretty linked. But in those quieter moments, do you see different signals coming from different asset classes?
Well, a question the client asks is that is the rate market coming from Venus and the equity market coming from Mars? I don't think it is the case here. My strong view here is that the rates market is clearly responding to an oil shock that is triggering a reaction function from central bank. We were here a few months ago discussing our view of the Fed not being able to cut rates. Market now is in line with that. On the ECB side, they are going to move. Our call is that they will hike rates in June and September. And any shock on oil, energy, uncertainty about reopening of the strait require an adjustment in terms of the inflation shock and the bond market, where I also believe that the market will tend to overprice what is eventually delivered because the market wants to be compensated for that upside inflation risk. On the other side, the equity market is of the sanguine view that eventually a solution is going to be found, but there is a fundamental story behind that was just mentioned before. There is the AI story that is still the relevant theme. We believe that the AI upstream theme is a critical driver of the dynamic of the equity market, as it's going to remain. And at the same time, despite the oil supply shock, what we get from earnings is a positive message. So I think that the two narratives can run in parallel.
Right.
Clearly, the big challenge, in my view, is going to come in a situation which we don't anticipate, but is a tail risk, where not only you have free descent on the Fed, but you have a more opening of the hawkish distribution. Because I think that could be a potential challenge where clearly you're going to have less support on the cyclical side, and the tech could be the safe place to be in an environment where the damage from tighter policy is anyway going to take place.
OK, so there's room for Venus and there's room for Mars, but you're a bit concerned then, maybe, a tail risk, about higher rates in the States, or at least language around more hawkishness coming from the Fed. Is that going to a bit that boosts tech stocks, or it limits their growth?
I think it limits their growth, but it creates a relative outperformance relative to the rest of the market. I think that if I think about a sector that is probably more resilient relative to the monetary policy, in my view, is going to be tech.
Should it be so resilient to higher energy prices? Sorry, just to jump in again. These stories seem to be on separate tracks, higher energy prices, and we hear so much about the energy demands of AI. Why are these stories not finding each other?
Well, I think that the resilience of the AI investment and the upside from this computational demand goes beyond the challenge of the energy prices. And I think that why it is relevant to me is the same as the sensitivity to interest rates. If you recall, when Powell was asked about investment in data center being impacted by monetary policy, he was pretty clear saying that if you have an investment in data center and my decision of hike or cutting 25 basis points is going to change that, probably is not the right decision to start with. You should have a lower sensitivity in the tech sector to monetary policy move.
Actually, just picking up on that point, is there a sensitivity to the bond market? This is where I'm starting to see maybe some indigestion for the bond market when it comes to the data center build-out. It was interesting to see Alphabet earlier this week having to go around the world to raise money because maybe it's starting to feel a little bit of indigestion in the credit markets in the United States. Is that where the issue will lie in terms of the resistance, the ability of the market to fund the debt that is required to build this out?
I think that there is demand, and if you have good credit quality, I think what really changed over the last number of years is that bond market in government space and in corporate space have become an investable asset with decent return. And despite the concern that we have about the high level of debt, we find decent demand both on the government and the corporate supply. So I don't necessarily believe that money will not come there. Are we going to get a new issuance supply premium? Possibly, but it's going to be quite contained in an environment where these corporates are still able to generate earnings.
The US 10 years are what, 440 now? A bit below. Is there a point, I guess 5% a problem for the tech trade? When do these Venn diagrams overlap? Is it when rates start to creep higher? Is it when we start to get to some of those critical points? Do you know what kind of points there would be maybe some resistance and pushback?
I mean, we revised our forecast for 10-year at year-end from 445 to 450. It's still in a range where the Fed is not expected to do anything next year and maybe thinking about, we have one hike pencil in for September next year. So in that world, the market is not going to price an aggressive monetary policy hikes, and at that level, I don't think it's going to be a problem. Clearly, if you're going to have some fiscal concern that is basically going to build up, that it
US is running a pretty big deficit right now.
But demand at the moment is there. And, to me, the big anchor of the higher level of debt is the credibility of central bank, on which I feel quite strongly.
On the central bank question, so you're penciling in 2 hikes from the ECB, June and September. Does that push Europe into recession potentially?
I don't think it's enough. I think that the reason why the ECB reacted with a sort of a hawkish stance relative to the oil shock is that we were running above potential. We have the big fiscal expansion in Germany, and that created a bit of resilience that allowed the ECB to focus on the inflation shock. I don't think that 50 basis points of hikes are enough to take Europe in recession. Having said that, in one of our first publications when the conflict started, we put out a sort of a shopping list of what to buy in the escalation, and Europe was not at the top. Clearly, Europe is the relatively loser, in my view, of the oil shock, and clearly if that is happening in a dynamic where the headwind from energy is combined with headwind from the monetary policy side, then probably you have less room for Europe to do well in the next 6 months.
So a resolution around Hormuz could come in different forms, a resolution. I won't go through all the different potential options that could look like. But if we get some form of resolution, what is on the shopping list then?
Well, I think that, the US tech continues to go. I think that there is still the beta to the US tech, which is basically EM.
You're not concerned about how consensus that trade is?
It's real, it's happening. Computational demand is real, and to me there is a structural change coming from the new model from Anthropic that, as I was mentioning in our research, is basically creating an environment of fear of being obsolete. You invest just to be on the playing field, and that clearly requires this computational demand. Eventually, there will be a time when an investor will ask the return on equity of all this investment, but I don't think it's going to happen over the next 6 months.
That's interesting. Yeah, there's a time for asking about return on equity and return on investment. Maybe not now. I wonder how you see the benefits of AI spreading, and then Fabio, because we can talk about the data center players and all of the hyperscalers and all of the chip makers and the like, and the memory chip makers. I was reading a piece on the Markets Live blog that talked about optical stocks doing really well. This is now a key part of the infrastructure trade around AI, apparently, which takes you into the territory of telecoms, communications stocks, because they provide fiber, optical connectivity. I mean, this seems as if it's broadening again in new directions.
I think that probably the best way to answer the question is that we used to think about tech as Mach 7. Now we talk about AI 50, but probably there is a wider share of the S&P that now has a sort of a beta or a link to the AI theme. That basically means that even in a world where AI is the main driver, you may have a broadening beyond Mach 7 into the AI spectrum.
It's been great to see you. Thank you very much, Steve, for stopping by to see us.
Thank you.
Come back anytime. Fabio Bassi, Head of Cross-Asset Strategy, joining us from JP Morgan. Let's take a quick look at the Core 6. This is what the picture looks like first thing this morning. You have a more cautious set of numbers in front of you. It's interesting to see that ASML is bid quite strongly. Schneider is also still bid quite strongly. It doesn't feel like that tech narrative has completely dissipated, but Rheinmetall is softer. Elsewhere, luxury is also having a fairly good morning as well, which I think is interesting. Let's find out more as to what we are watching. I'm going to start in the energy space, or at least Chloe Melly is going to start in the energy space.
Good morning, Gail. We're seeing a little bit of weakness in Shell this morning, and it did report as expected, profit rising because of the surging oil and gas prices since the start of the war in the Middle East. But maybe because expectations were so high, maybe because the buyback is a little bit smaller than investors are used to, we are seeing some of that weakness this morning, and we're down about 2% for Shell this morning. We're also down for Siemens Healthineers, which has cut its outlook. It's facing a few challenges, including inflationary pressures and also a pricing policy in Chinese healthcare that is unfavorable to its business. And of course, a guidance cut is being reacted to quite negatively this morning, and we're down about 4% for that company. It is in the green, however, for Legrand, which is the French electrical equipment maker. It reported sales and profit ahead of estimates. It's really been a big beneficiary of all these investments in AI infrastructure, in energy transition infrastructure, and so it's following in the footsteps of some of its bigger peers like Schneider Electric and ABB, and we're up quite strongly on the back of those results this morning, about 3%. It's also good news for Intercontinental Hotels, which has reported better than expected numbers for the first quarter, and also said that any impact on travel demand from the war would actually be offset by really strong demand elsewhere, including in China and the US. And so that is quite reassuring from this kind of travel industry perspective, which had been worried, of course, about the impact on travel demand. And finally, Campari is down quite significantly this morning after weaker than expected results and also quite disappointing guidance. And so it seems that even in those really tough times, no one is reaching for an Aperol Spritz, and that is, of course, quite bad news for Campari.
That just feels tragic. Chloe, thank you very much. Chloe Melly with the latest on those movers. I've got another one to throw into the mix, and that is Zealand Pharma, operating in the obesity space, initiating a share buyback. That is something that is boosting the shares, but also the fact that the numbers are not as bad as had been anticipated is having a positive impact as well. Operating loss, pre-tax loss, all of those are smaller than had been feared, and so that particular Danish business goes higher this morning.
OK, well, we'll stay on the Danish story because coming up, Pandora, charming investors. Thank you, producers, for that. Shares currently a little softer, actually, down about 0.6%. But the Danish jeweller's first quarter earnings met estimates, maybe a little bit above. We're going to speak to the CEO of Pandora live. That is coming up. This is Bloomberg.
Thursday the 7th, good morning, or as we're calling it, Denmark Day. We've already spoken to a series of Danish companies this morning, Maersk, Vestas. We've talked about Zealand Pharma, and we're going to carry on the conversation now because Pandora is the next company we should talk to. The stock is off a little bit this morning, but it was up a lot yesterday. So you need to bear in mind what you're looking at here is a 2-day chart, and the performance is fairly positive. The company's first quarter EBIT margin beating estimates, with analysts noting an improved sales trend that has continued into the second quarter. Joining us now is the new CEO, Berta de Palles-Dimmock, Pandora CEO. That's a nice title.
Thank you.
How's it going? You having fun?
It's going well, having fun, making great things for the brand, and results yesterday were good, so we are pretty satisfied. We beat quarter one expectations on both top line and bottom line, despite very difficult times and a lot of headwinds.
Why difficult times?
Well, as you can see, there is a lot of geopolitical turmoil in the world. We are seeing consumer sentiment degrading in some of our markets, notably the US, for example. In some of the European markets, the situation has not improved, so it's been stably low. And of course, as well for Pandora, we've been having quite a lot of headwinds at our EBIT line. So we have, of course, the tariffs, weaker dollar.
Still north of 20% though, on the margin.
Yes, absolutely. And
can you keep it there?
Yeah, we are going to, because one of our biggest challenge is the price increase of silver. It has increased nearly 4 times in the last year. When we started last year in 2025, it was at about $32 per ounce. I mean, yesterday was 80, 79. It's just hovering.
Imagine you pay attention to that on a daily basis.
I'm looking every single day what is the price of silver, because sometimes. But we have already announced what are the plans for that. We are going to be replacing a big part of our silver assortment to a new proposition that is platinum-plated jewelry. So by doing that, by the time we are with the transition, we will be able to bring back the company to around the 20s that we are today. So that's the plan.
So this is one of the self-help measures, I suppose, in the face of higher silver costs. What's the customer perception of that? Does the consumer notice or mind?
I mean, that's the right question to ask, right? Because we can solve out for a cost issue, but if the consumer doesn't accept our products, it's not good. So yes, the reason why we went to platinum plated is because we did a lot of consumer testing. And what consumer told us is, listen, when I look at jewelry, I look at my yellow metal, and you are already doing gold plated. We are pretty used to gold plated. I'm wearing some today. And you have the white metal. For white metal, we look at different positionings of different alternatives, and platinum can really strong. Why? Because it's a precious metal. It's already used in jewelry. But most importantly, some of our barriers for our consumers is that silver tarnish. Whereas platinum plated will be a better proposition because it doesn't tarnish, so you can go to the...
So you can even sell it as a positive, sell some of the upsides. What about the tariff story then? How is that affecting the Pandora business? We had seen some businesses benefiting the first quarter of last year from a stocking high inventory levels ahead of tariffs. And maybe that makes things a little more difficult in this reporting season. But what's the tariff story as it affects Pandora?
Yeah, in quarter one, it has affected negatively because they were not announced. It was only on the 1st of April. So quarter one, we were actually overcoming the tariffs that we didn't have the year before. So quarter one has been a negative impact for us. But again, the biggest one still remains silver. So all in all, is not the biggest chunk.
Do you, some of the companies are getting rebates now because of the Supreme Court ruling. Are you going to push for a rebate? Do you expect to get a rebate?
Yes, we have already applied to get a rebate, so we haven't got it yet. But yes, we are one of those companies.
How much could that be?
I'm not disclosing exactly what that is going to be, but you can just make the calculation of what it will be. But let's say...
Are we talking millions of dollars? Or?
No, we're talking millions of dollars, yes. It's a substantial part on our EBIT last year, so we managed to absorb already part of that. But yes, it will be important.
And you said near the top of the interview that the US consumer is degrading. What does that look like, particularly? What is driving that? Does that continue? How concerned are you about the US consumer?
Well, we are concerned. If you look at our quarter four results already, we start seeing a deceleration of our results in the US. We finished negative in quarter one. And what we are seeing is that the consumer sentiment is at its lowest since the 60s. But what is interesting is that when you look at average, it might look not that bad. But the interesting thing is that there is this K-shaped economy building up.
And you're in the middle of that.
Well, if you look at our Pandora consumers, it's mainly on the middle income and low income. And the consumer sentiment is disproportionately lowering down on the middle and low income, whereas the high income is actually going quite positively. So that is, of course, a concern for a brand that is all about accessible and affordable jewelry.
What is your priority from here in terms of how you are repositioning the business? How much money comes back to shareholders? How much money do you still need to invest in the company? Can you deliver beyond kind of this year and next year a shareholder return story that looks compelling? How are you thinking about that side?
Yeah, absolutely. I mean, Pandora has been one of the record shareholders' return in the last years, and our intention is to continue to do that.
Right.
We have to basically do two main things. The first one is to make sure that we are protecting our profitability, and the biggest headwind that we have is silver. We are already addressing that with our platinum-plated jewelry. That's number one. The second is that we need to bring back growth, and one of the challenges that we have is that, well, first, we are doing really well in regions where Pandora is less penetrated, so the ownership of the brand is less. So Latin America, we grew 6%. Asia, we grew 12%. There are certain markets in Europe that are growing 10%, etc. The issue that we have is in the markets where Pandora has already existed for many years. There is already an ownership of 40%, 45%. So there, what we are doing is to focusing on two things. We need to bring more exciting newness into our collection. So it's about re-energizing our collections. And we need to adapt as well to be more exciting into the digital channels, social media, what we call the earned media.
And does that lead you to question where Pandora is in terms of price points and that K-shaped economy? Do you ask questions about that? I mean, you've had an incredible range of consumer-facing experience. We were discussing in the break how in the past you've been involved in brands such as M&M's and Moët. You know, these are at different ends of some kind of spectrum. So are you happy with where Pandora is positioned, given the consumer challenges that it's facing?
Yeah, absolutely. I think in any business, you have to look into what was the initial founding myth of the business. And Pandora was always about providing accessible jewelry to the many. So high quality, high design, and accessible prices. This is what we have been for more than 50 years, and we will continue to be. So our challenge now is let's make sure that we keep the brand exciting and with more collections. And top line is already stable. It will continue to grow, and the returns will be there. I'm very confident about that.
Berta, thank you very much. Thank you for joining us. Berta de Pablos-Barbier, the Pandora CEO. Quick check on some tech news, Tom.
Yeah, this is a newly listed company in Stockholm, Silex Microsystems, and the stock is surging 111% right now. So this is a provider of tech hardware equipment to the fabs, and specifically around things like accelerometers, microelectric mechanical systems. Or did I say it? Components that combine mechanical elements and semiconductor-style circuitry. So they ship this stuff into foundries. And there's clearly a lot of enthusiasm. Sure, the shares popping.
There are a lot of vowels in there. All of those vowels competing to get out.
Yes. OK. We're going to stay with tech next, aren't we?
We are. We're going to have a really fascinating conversation about quantum computing, a huge boost for UK-based computing firm Quantum Motion. It's raised as much as $160 million in a financing deal. Could be one of the biggest for quantum computing in the UK. We're going to speak exclusively to Quantum Motion's CEO, James Palles-Dimmock. That is next. What is the future of quantum computing and how well placed is the UK? That's coming up. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session. It's 8:30 a.m. here in the City of London. It's a Thursday. European stocks across the benchmark up 0.2% after a very strong session yesterday, of course. So building on those gains modestly, but there is a bit of anticipation, a little bit of caution, arguably, as we await more details around a potential deal between Iran and the US. With all those caveats, DAX is gaining 0.3%. On the central banking news, Riksbank over in Sweden leaving its rate on hold at 1.75%. That was bang in line with the estimates. That was fully expected by economists out there. There is a tension in Sweden around concerns about the growth and potential growth slowdown, and of course the inflation story. That's not unique to Sweden, of course. So this was expected. 175. There's a view from Bloomberg Economics that they will keep rates on hold for some period of time. That's the movement in terms of euro krona. Not a much of a move. The euro just up 0.1%. But again, 175 as expected. Guy, what are you looking at across the markets?
At an index level, we're fairly quiet. Below the surface, we are definitely not quiet. Look at what is happening. 364 up, 220. 26 down, but volume is big today. The market is still seeing a follow-through from yesterday's session into this Thursday session. So that's the picture kind of just below the surface. Let's go a little further below the surface and talk about some of the other single stocks that we are watching. Lufti's up quite a lot. Lufthansa trading to the upside. Understandably, lower oil price, that's better for the airline sector. Now, Lufthansa's painting a fairly positive picture about its fuel story going forward from here, but we are up by 5%. Legrand in the energy space is also up quite strongly. 3.72% feeds in to that data center narrative. But the star of the morning is Zealand. It is up by 12.72. As Anna was saying, could have been worse. The data are actually looking better. Let's talk about where we are seeing some laggards. Campari down 11.5%. That is a big move. The drink story maybe not looking quite so positive. Maybe we're not all feeling quite so positive. Bouygues is down by 1.74%. What is interesting is that Shell is also off this morning. You've also got the factor to fold into that trade this morning of the lower oil price. So you need to just bear that in mind. Not all related to what we're seeing on the earnings picture. You are also seeing a factor of the lower oil price being priced into that stock, Anna.
Let's get up to date on some of the other stories that we are keeping in focus this morning. Voters in Scotland, Wales and much of England head to the polls today in the biggest UK electoral test since the general election almost 2 years ago. Polling stations are open until 10 p.m. in the elections for English local councils and the Scottish and Welsh parliaments. The US has presented a one-page memorandum of understanding to Iran that would gradually reopen the Strait of Hormuz and lift the American blockade on Iranian ports. Iran is expected to send a response, we've not yet heard from them, to the United States proposal via Pakistan in the next 2 days, with state media signalling that parts of the proposal remain unrealistic to Iran's leadership. And Bloomberg has learned that China's financial regulator advised the country's largest lenders to temporarily suspend new loans to 5 refineries recently sanctioned by the US over their ties to Iranian oil. The move contrasts with a notice 4 days ago from China's Ministry of Commerce, which instructed companies to disregard US sanctions. All of that beating a path to that US-China meeting next week, Tom.
OK, let's get back to the tech story. ARM, which has exposure to China as well, interestingly. ARM shares falling in late trading after disappointing investors with its sales forecast for the current quarter. The firm warning of smartphone market weakness while saying that AI data centre growth would offset the slump. Let's bring in Matt Bloxham from Bloomberg Intelligence. Matt, what stood out to you from the ARM earnings?
Yeah, I think obviously that smartphone weakness comment was interesting. I mean, maybe not that surprising because we're seeing all this upward pressure on chip prices, and that's affecting particularly kind of low-end consumer devices, including smartphones. I think the other thing that stood out was the kind of more optimistic outlook they gave on this new AGI CPU. And actually, I was kind of reminding myself of the interview you did with Randy Haas not so long ago about the launch of that. You know, I think at the time they talked about $1 billion of kind of supply-based outlook revenue, and now they're kind of talking about $2 billion. So there's clearly kind of strong appetite for that. And I know there's been a lot of questions about whether entering into the kind of chip manufacturing and product market would maybe kind of compromise their neutrality, but it seems that there's demand out there and they're very optimistic about it.
Can I talk about this Anthropic deal with SpaceX?
Yeah.
So when I first read the story, it made me kind of think about the SpaceX IPO that's coming up, and this sounded like a very good wheeze to get maybe some of the numbers to look a little bit more positive. Am I being too cynical there? Is there a kind of realistic narrative backdrop to this deal?
Healthy cynicism, maybe. Guy. I mean, look, you know, any company that's coming for IPO wants to demonstrate they've got a good forward pipeline of revenue. Having a big anchor customer like Anthropic in your massive data center in Memphis is a great way to kind of underpin confidence in the revenue outlook. I mean, it also speaks to the reality that there is a real challenge with finding enough capacity to fund and operate all of these big AI models. Obviously, Anthropic's been a runaway success, probably a much bigger success than even they thought it would be in such a short space of time. So they probably are having to kind of think of alternative avenues to kind of deliver on that capacity and maintain the performance of their product. And it is quite a contrast because, you know, it's not so long ago that Elon Musk was being quite critical publicly of Anthropic. So it is a bit of a 180-degree turn. And maybe both of them had to kind of swallow a bit of their ego just to kind of get this deal over the line.
Yeah, two things can be true at the same time, can't they? Matt, thank you very much indeed. Matt Bloxham wrapping the Anthropic numbers and ARM as well. Let's stay on the tech story, and interestingly, energy is a piece of this as well, because Quantum Motion has closed a $160 million Series C funding round led by EU-backed tech growth fund Kinvara. The financing positions the British startup to deliver quantum computers made with the same silicon chip technology used in laptops and phones. Joining us in the studio for an exclusive conversation is James Palles-Dimmock, Quantum Motion's CEO. James, good morning. Thanks for joining us in the studio. Explain to us then what it is that you do at Quantum Motion that differentiates you from others in the quantum space, to which a lot of funding is now flowing, it seems.
Yes, indeed. We make quantum computers, but we do so using standard CMOS chips. So we make the full stack system. This is something that's available to users now. We've deployed a machine at the NQCC. The differentiating fact is, rather than these machines swelling to the size of being entire data centers, as some other modalities will, we can deliver a full utility-scale machine in the size of a few server racks. That's really the key thing that's got investors behind it.
And just for clarity, so the National Quantum Computing Centre, the NQCC, is where you've deployed. Why aren't others doing this then? What is your moat? Why aren't others just shifting to a silicon-based approach when it comes to quantum computing?
It's a good question, because silicon always wins, right? So why not back this? Largely because a lot of these other companies have started up out of university labs. So superconducting, ion traps, these have largely been, labs that have been bought out by the likes of Google, and then that's grown their own internal effort. When we started the company, we started in a very different way. You couldn't do this within a university lab. We had to build a company to work with some of these mega foundries, the likes of global foundries that we work with. And that's the way. We started out knowing that a useful quantum computer needed millions of qubits. And the only way to get there was to leverage the multi-trillion-dollar CMOS industry to have our fabrication.
And you mentioned, good morning to you, you mentioned the partnership with global foundries. So I wonder what that entails. What kind of access to chips are you going to get? There's a lot of competition for chips at the moment.
This is true. The good thing with our approach is that it's relatively standard. So we make this using their standard 22FDX platform, and indeed our chips can sit next to washing machine chips or others that you might use in your everyday life. So it's what's called a multi-project wafer. We can sit our chip right next to that and go through standard runs rather than needing any sort of line changes to their tooling. And
you've announced this morning then that Kinvara, which is a growth fund, we understand, backed by the EU, it's made its first investment, and it's a vote of confidence in you and what you're doing. What do you think it was about what you're doing that made this investment take place?
I'm delighted with the global investment backing. So this was led by DCVC and Kinvara, and as you say, like two of the world's best deep tech investors. What they recognized was similar to what we've just said. If you can build a quantum computer and it uses 100 times less energy, 1,000 times less energy, and 100 times less expensive than some of these other modalities, that's a huge moat.
What can I use it for?
You can use it for anything that the world's most powerful computer can be used on. So it can be used to understand nature at the deepest level. That means that you could, if you imagine, optimize every industrial process that we currently have. Imagine that you can slash the energy cost of generating ammonia for our fertilizers. This would have such a transformative impact on our society that this is another reason why these investors are delighted to get behind it.
Am I going to need all the data centers we're building at the moment if you are the future?
You will. This won't replace them. It will enhance them. This is very much an additive technology.
But at the moment, there's huge amounts of investment going into AI. Can you do what they are doing, but for less? You talk about the energy sort of component of all of this. At the moment, that is where the challenge lies in so many ways. What will what you're doing do differently and to your words, enhance what we're doing there?
Yeah, so AI is, I guess, a kind of big memory problem. You've got these massive data sets, and you've got to chunk through that. Quantum computing is small data, but very complex calculation problems. This is really where we differentiate. So they are different use cases, but it allows us to do things smarter than you would if you were just to take a kind of brute force, let's train an AI and kind of look at where the data leads us. You would actually be able to perform these calculations, essentially with the eye of God, understanding what nature is trying to tell you, rather than inferring and extrapolating from large data sets.
With the eye of God, that's a lot of visibility.
It's pretty good.
So the grid is under enormous pressure because of AI already. Other quantum computing approaches could put additional pressure on the grid. You're saying that that's not workable. I mean, does that suggest that IBM Quantum, Google Quantum, IonQ, Quantinuum, other competitors, that fundamentally their approach to this is mismatched to the energy that we currently have? That that faces that's a fundamental issue for some of these competitors. Is that the case you're trying to make here?
Yes, and there's already examples where you can see that these very large infrastructure projects that governments have got behind to deploy some of these early quantum computers are using couple of hundred megawatts, and indeed needing facilities the size of one data center for one computer. And that's not a future that I think we can build with quantum computers. I think there will be demand for not just one, but millions of these. And at that point, you can't possibly conceive that each one of those will be an entire data center. There has to be a solution, our solution, where you can shrink those, miniaturize the cost, the energy, and then therefore democratize that, give access to everybody that will actually get the best out of this technology.
We've done a deep dive, our colleagues at Bloomberg News have done a deep dive into financial services and Wall Street and the way it's looking at quantum and investing in it and asking questions about whether it can deliver great things. And the banking world seems to be divided. There are some that are still investing and thinking this is a big part of the future, and others who are a bit more sceptical. Goldman Sachs, at the end of one investigation, saying they realised it would take millions of years to run the algorithm they were trying to run, and it would need 8 million qubits, which I'm informed is a lot. So, this didn't seem to live up to the expectations of what they thought it was going to be able to do. How is the thinking on that front evolving?
But that was actually a very good news story. So we worked with Goldman after that particular piece of work and demonstrated that rather than taking that length of time, you could actually reduce that particular derivatives pricing algorithm to run in 8 hours on our particular machine. That was a combination.
So what was the first number?
Millions of years.
Right.
So there was
that's shorter.
There was work that we published with them that demonstrated that you're entirely right, that the way that you can shrink that problem to make it run faster is actually to make it on a bigger quantum computer, more qubits. That's really where our approach comes in. So you're entirely right. Millions of qubits are required, which is why the density, the cost per qubit is a critical part of this story. And that's what you can solve. If you've got something that can make billions of transistors, that should be the technology that you use to make qubits.
James, if you're successful, do we have to fundamentally rethink valuations for AI?
I think the valuations on AI, we're starting to see potentially the revenue that's backing them. I don't think it's quite as absurd as people initially thought. People are starting to see why. I think actually this can start a flywheel of increased compute power being available to many, many more people. So it's more allowing people to do what people do well, creative tasks, and allowing us to optimize every industrial process using what computers do well.
And how wedded are you to the UK? Would you list here?
I am very wedded to the UK. We've been backed by the UK through the British Business Bank, but we're also a global company. We have presence in Australia, in Spain, investment from the US, so it's necessary for us to take this technology to the world.
Okay, James, thank you very much indeed. James Palles-Dimmock, Quantum Motion CEO, on the back of that raise, $160 million Series C. Stay with us on tech, because we're going to explore what is happening in terms of self-driving. London's unpredictable streets, pushing self-driving technology to its limits. For Wave, that challenge is forcing a rethink of how autonomy is built as it prepares to launch in the British capital later this year. I spoke to the CEO, Alex Kendall.
London is a driving environment that is so complex that it almost forced us to take this more scalable approach, because mapping and driving with remote systems where you've got challenges on your connectivity infrastructure, or London is a 2,000-year-old city, so you've got way more roadworks than you have in San Francisco. I think about 20 times more roadworks. You've got about 10 times more cyclists and pedestrians than San Francisco. So all of this adds up to a much more complex autonomy challenge that requires a rethink and a scalable approach.
Well, you can see more of that interview in the next episode of Bloomberg Tech Europe, which looks at how the race for driverless cars is heating up. We're going to explore the battle between Waymo and Wave. It's a bit of a David and Goliath story, and ask who will win the road. That is tomorrow at 8:30 a.m. UK time, right here on Bloomberg TV and on the terminal YouTube and on our video hub at bloomberg.com/video.
There was nobody in the front, right?
There was a safety driver in the front.
Oh, right. Okay.
There was but they didn't touch the wheel the whole time.
Okay. Amazing. It's going to be transforming London, potentially. Talking of which, we're going to transition to Shell, talking about its profits surging, driven by obviously what is happening with the crude story. We'll have more details to follow. That's next. This is Bloomberg.
We have multiple ships that are stuck in the Gulf, and we've taken a very prudent approach towards what we can do to get those ships out, because the safety of the crew is our really utmost concern. But as long as there is a naval blockade, since you have only these two routes, it's fairly easy to monitor what is going through. As long as there is this, they will have to stay there, because we cannot risk the life of our crew, we cannot risk our assets or our customers' cargo also by going through something that is unsafe.
Vincent Clegg, the CEO of Maersk, speaking to us a short time ago, talking about the impact on their business, looking back and looking forward, talking about vessels being stuck in the Persian Gulf. Well, Shell, the CFO there, saying 10% of their oil and gas output is offline as a result of the same incident, the Iran war, of course. Let's talk more about Shell. The company says its profits surged in the first quarter as the war drove oil and gas prices higher, adding the surge in volatility boosted its trading business. Let's speak to Mitchell Furman, who covers big oil companies for us here at Bloomberg. And Mitchell, good morning to you. So they have benefited from the volatility in oil prices, certainly on the trading side. How good has it been for that particular part of the business?
Yeah, Shell characterized it as a strong quarter for its oil traders, and it has a large, sprawling in-house trading division. And, as a result of these higher oil prices, its traders were able to capitalize on these market dislocations.
Do we see that? I mean, to what extent can that be sustained? And is the reason we're seeing downside pressure on Shell stock today is because of the CapEx spends came in higher than expected? And where is that CapEx spend going?
Yeah, the CapEx spend is in part due to its recently announced acquisition of ARC Resources, the Canadian oil and gas producer, which Shell is looking to increase its upstream reserves. Shell's shares are falling in line with peers as oil is down, as you guys mentioned.
It's more of a soft oil story.
The macro
questioning the earnings.
Yeah, well, and the macro oil is Brent is down as the U.S. and Iran appear to be kind of potentially nearing a diplomatic breakthrough.
They kept their outlook. How much visibility does a company like Shell have right now, given the turbulence that we've got?
Yeah, Shell is like other companies. A lot of this depends on the ceasefire and the war ending. Yeah. That's when they will ultimately feel comfortable to send their ships through the Strait of Hormuz. The CFO, I just got off a call with her, and she was talking about how 10% of Qatari volumes are offline. And the first step to getting flows going again will be the Strait clearing.
Yeah. After that, what happens? Did you give any?
Yeah. She mentioned at first it'll take a couple weeks for the Strait to really kind of clear the backlog of ships, and then Shell will have to restart its production in Qatar. Then it can start shipping new flows out.
I mean, things being peaceful enough to leave seems one thing. Peaceful enough to go back in is another. I wonder if this changes the dynamics in that region on the longer term. I don't know whether oil execs have been talking about that.
Yeah, and Shell's acquisition last week announced of ARC Resources. It's a Canadian producer outside the Middle East.
Yeah.
Shell has an LNG export facility on Canada's west coast, which is geographically located toward Asia, which has been feeling the impacts of the Middle East disruption. So, while Shell kind of maybe downplayed some of the geopolitical relevance to that deal, that there seems to be indeed some connection to some degree.
Okay, Mitchell, thank you very much indeed. Mitchell Furman on the oil story, with Shell down 2.2%, but to Mitchell's point, that's largely down and more likely down to oil and Brent down below $100 a barrel, falling 1.6% in the session after a pretty decent set of numbers from that company. Let's look ahead to what else we are watching throughout this Thursday, 9 a.m. So closing in on this is the UK Norges, in fact, that's UK time. It's the Norges Bank rate decision. That's after the Riksbank kept rates on hold at 175. So we'll break that for you. And it's UK local elections here in the UK, 1:30 p.m. UK time, US initial jobless claims. And on the earnings front, we've got McDonald's in the US, and then Marco Rubio will be meeting the Pope.
Could be interesting.
Yeah.
Let's talk about these markets and what is going on. What is emerging is that this Chinese visit by President Trump to meet his counterpart is now emerging as a major factor when it comes to market thinking. President Trump said he's looking forward to going. Does this trip happen? Does it not happen? If it does happen, what does it deliver? That appears to be a big factor now. So let's talk about kind of how we price that in. Scullin Montgomery Koenig joining us around the table.
is it risk on until then? What happens if Trump doesn't go? What happens if this trip doesn't happen? If it doesn't go well, what does it look like? There seems to be a lot of imponderables around this.
Yeah, I mean, I think there's a lot of vulnerabilities when we actually get to the event, or at least closer to it, but it's kind of mid next week, right? So at least until the end of the week, we can be more positive. And I think
I'm just going to point that out.
I think right now we've had some more positive news in terms of de-escalation. I mean, I'm not sure it's actually de-escalation, but more positive soundings from both sides in terms of a deal coming to fruition. And markets are looking to that point and saying, well, they're not going to want to escalate before then. And we've seen from equity markets that, you know, they can be very much cheered by oil prices coming down, but the beta to oil prices rising has decreased significantly. And I think what we need to remember is that equities are biased to rally most of the time. In years when you have peaks in the MSCI world, on average, you get 19 highs that year. And, you know, the most highs we ever had in a year was 77. So it's not unreal or realistic in this environment to see more highs coming.
It seems interesting to me that we are waiting with great anticipation and seem to have already priced in a memorandum of understanding that might not actually answer all the questions at all, might just be a sort of opening salvo for a 30-day negotiation. We might still be thinking about whether we can find common ground between the US and Iran around nuclear weapons, for example. That might still be an open question, even if we do get agreement. And I guess I'm asking this because might it be better to travel than arrive, to use that dreadful adage in markets, that we've priced all of this in, and then when we see the reality of what we get, if anything, it might be disappointing?
I guess the issues around nuclear agreements, etc., that's not really something the markets are concerned about. Yes, it kind of brings into question why you've started the war in the first place if you end up in the same place at the end. But what the market cares about is the flow of oil. So as long as you get the straight opening and that flow starting, and you can see a path to the end point of having that oil coming back online, that's what the market cares about, because that will feed into your growth and inflation expectations, your economic backdrop.
As we look at and think about inflation, clearly that is percolating through the US consumer as well. We're seeing that in terms of the price at the pump. How solid is the labour market in the US? We've had some data out in the last couple of days. You've got non-farm payrolls tomorrow. How much of a focus is that, and what are you expecting?
Yeah, I mean, with non-farm payrolls, the expectation is a pretty good number at 65,000 on the headline, unemployment rate staying steady. And I think that's really what you need to watch, because the worry with non-farm payrolls right now is that it oscillates quite significantly, but the break-even rate is a lot lower because you've had this labor supply reduction in immigration. And so as long as the unemployment rate stays steady, that's a sign that your labor market is still on solid footing.
Okay, 4.3% I think is the forecast for unemployment. Bloomberg MLive strategist Scarlett Montgomery-Coding, thank you on what the market is thinking about today and looking ahead to tomorrow. Coming up, Double Line CEO Jeffrey Gundlach. That interview's coming up 8 p.m. London time, so stay tuned for that. That's it for the opening trade. The Pulse is up next. This is Bloomberg.